Well, hello there. That battery can last up to 24 hours, even with the always-on display turned on. It's pretty cool.
Hey everyone, welcome. If you're a business owner or a freelancer in Canada, I've got a question for you. Have you ever stared at your tax bill and just thought, ugh, there has to be a better way? Well, you're in the right place. Today, we're going to pull back the curtain on Canadian business tax deductions. I'm going to show you how to confidently claim what you're actually entitled to, and you won't have to radically change your life to do it. Okay, let's get into it.
So here's our game plan. First, we'll dive into what I call the deduction dilemma, that feeling of uncertainty that so many of us have. Then, and this is huge, we're going to uncover the single most important legal test that actually puts the power back in your hands. After that, we'll look at some fascinating real-world court cases to see how this all plays out. Then we'll build a practical toolkit for your own expenses. And finally, I'll give you the keys to basically audit-proof your business. I promise, by the end of this, you're going to feel a whole lot more in control.
All right. Let's get right to the heart of it. Let's talk about the uncertainty and, let's be honest, the fear that can creep in when you're thinking about claiming business deductions. It's a totally common feeling, but it really doesn't have to be your reality.
Okay, I want you to meet Julie and Janet. They're twin sisters, and they're both killing it, earning around 75 grand a year from their creative work. Julie's a painter, and Janet's a freelance writer. Logically, you'd think their tax situations would be pretty similar, right? Nope. Not even close. They were paying wildly different amounts in tax. And the reason is simple. Janet was a bit passive, maybe even a little intimidated by the whole process, so she didn't claim all the deductions she legally could have. Julie, though, she was informed, she was proactive. It's the perfect example of how just knowing your rights can have a massive impact on your bank account.
This is the million-dollar question, isn't it? The one that keeps business owners up at night. And here's why it's so darn tricky. The Income Tax Act isn't always black and white. A lot of it is open to interpretation, and the Canada Revenue Agency, the CRA, has a ton of power to go back and reassess your return if they don't quite see things your way. It can feel like you're playing a game, but the other team owns the rulebook and has all the referees on its side.
But what if I told you that the rules of that game fundamentally changed? A huge Supreme Court case came along and created a much clearer, much more secure playing field for all of us entrepreneurs. Let's talk about the one test that truly matters now.
For years, this one little phrase was the CRA's favorite tool. They could look at any business that was losing money, which, let's face it, is most startups, and just say, you know what, we don't see a reasonable expectation of profit here. And poof, they could disallow all your legitimate losses. It let auditors second-guess your business decisions with perfect 20/20 hindsight, a luxury that no entrepreneur ever has when they're in the trenches trying to build something.
And then everything changed. The Supreme Court of Canada, in a landmark case called Stewart v. Queen, basically threw that old fuzzy test right out the window. They replaced it with a question that is so much simpler and so much more powerful. Is this activity commercial or is it personal? That's it. If what you're doing is clearly a business, not just a hobby, then your expenses and your losses should be allowed. This was an absolute game changer. It leveled the playing field in a massive way.
So, what does this commercial versus personal idea actually look like in the real world? Honestly, the best way to wrap your head around it is to look at how the courts have handled it in actual tax cases. And trust me, some of these are pretty wild.
Okay, you gotta hear this one. In the Scott case, a self-employed foot courier in a big city tried to deduct the cost of the extra food and water he needed to get through his day. It was a super physically demanding job. The CRA, of course, said, no way, that's personal. But the court, they saw it differently. Their logic was just brilliant. They said, look, if fuel for a delivery van is a business expense, then why shouldn't the extra fuel for the human engine doing the exact same job also be a business expense? So they allowed it. Amazing, right?
Next up, the Gideon case, which deals with a huge worry for anyone starting a new venture, those early losses. So, a couple bought a rental property, but because of a tough economy, it lost money for 3 years straight. The CRA stepped in and disallowed those losses, but the court actually overturned that. They pretty much scolded the CRA and said, hey, you have to give a new business a reasonable amount of time to actually get up and running and become profitable. This case set a vital precedent. Those early-stage losses in a real commercial business are absolutely deductible.
Now, it's really important to see that this logic can cut both ways. In the Mullen case, a taxpayer was building houses and then selling them super quickly, quick flips. They tried to claim the profits as capital gains because they're taxed at a much lower rate. But the court looked at how often they were doing it and the whole nature of the transactions, and they said, whoa, hold on, this isn't a long-term investment, this is your business. And because it was a business, 100% of the profits were taxable. It's a great reminder that it's your actions that define how you're taxed.
All right, so now that we're armed with this core principle of commercial versus personal, let's get super practical. It's time to build a toolkit that you can use day in and day out to classify your expenses and finally feel confident when you go to file your taxes. So think of it like this. Every single dollar you spend in your business fits into one of 5 main buckets. You've got your current expenses, that's the day-to-day stuff like office supplies, which are fully deductible right away. Then there are capital expenses for bigger things that last, like a new computer. We'll also quickly cover prepaid costs, restricted expenses like meals that have special rules, and of course the not allowable bucket for things you can never claim, like a speeding ticket.
And this right here, this is where it all happens. This is Form T2125. I know, it can look a little intimidating at first glance, but honestly, it's just a scorecard. You list your income at the top, and then you just sort all those expenses we just talked about into their proper categories. Getting comfortable with this form is the real key to making this whole process feel way more manageable.
Let's tackle the big one that everyone asks about, the home office. Can you deduct your home expenses? Yes, 100%. But, and this is a big but, the key word is portion. You can't just write off your entire electricity bill. What you have to do is figure out the square footage of your dedicated workspace, calculate that as a percentage of your home's total size, and then you apply that percentage to all your eligible costs. Things like utilities, insurance, and, this is super important, only the interest part of your mortgage payment. You can't claim the principal. Okay, so that's your home base covered. But what about when you're out and about? Your vehicle is another place where you can claim some major deductions for gas, insurance, repairs, you name it. But there is one non-negotiable, unbreakable rule. You must keep a detailed logbook. You need to track your total kilometers for the year and the total kilometers you drive specifically for business. I'm telling you, without that auto log, if you ever get audited, your entire vehicle claim is almost guaranteed to be denied.
Now, all that driving around to meet clients often leads to another really common expense: lunches, coffees, that sort of thing. And this brings us to the infamous 50% rule. For the most part, when you take a client out for a meal, you can only deduct half of the bill. But, and this is where knowing the details really pays off, there are exceptions. For instance, staff parties, up to 6 of them a year, can be 100% deductible. And get this, meals and drinks that are served to you on a plane or a train while you're traveling for work can often be fully deductible too, so hang on to those receipts.
Let's quickly clear up 2 more tricky areas. First, clothing. Can you write off that sharp new suit you bought for client meetings? Sorry, but the CRA's answer is almost always going to be no. The rule is, clothing is only deductible if it's a specific uniform or a costume that you couldn't reasonably wear on the street. Think steel-toed boots for a contractor, not a blazer. But while you can't deduct your clothes, you absolutely can deduct investments in your most important asset, your brain. Training that maintains or updates a skill you already have for your business is 100% deductible. Just be aware, if a course gives you a whole new degree or qualification, it might be treated differently, as a capital expense.
Okay, so you've done all the work, you understand the big principles, you've claimed your deductions confidently. Now for the final piece of the puzzle. How do you make sure all your claims are absolutely rock solid so you can sleep at night and not worry if the CRA ever comes knocking?
This right here, this is your audit-proofing Bible. It is all about documentation, documentation, documentation. Get a receipt for absolutely everything. And here's a golden tip. For that client lunch, as soon as you get the receipt, flip it over and write down who you met with and the main thing you talked about. Use some kind of bookkeeping system, even a simple one. And have I mentioned this? Keep that meticulous auto log. I'm telling you, these simple habits are your absolute best defense. They tell the financial story of your business.
And just in case you're wondering why all this matters so much, just take a look at the cost of getting it wrong. The penalties for non-compliance are no joke, and they add up fast. Just failing to file on time will cost you 5% of what you owe, plus interest that compounds monthly. And if you make false statements, even by accident, the penalty can be a whopping 50% of the tax you tried to avoid. Being proactive and compliant isn't just about following the rules. It is smart, financial self-defense.
But hey, nobody's perfect. What if you're listening to this and you realize, oh man, I think I made a mistake on a past return? Don't panic. The CRA actually has something called the Voluntary Disclosures Program, or VDP. It's a system that lets you come forward and fix your errors. Now, if your application gets accepted, you still have to pay the taxes you owe, plus interest. But you can often completely avoid the penalties and any legal trouble. It's a really valuable safety net, but it's always smart to get some professional advice before you use it.
So I want to leave you with this question.
After everything we've talked about today, from that game-changing Stewart test to the nuts and bolts of your home office and your car, what is a legitimate business expense that you've been too afraid to claim? The goal here isn't to be reckless or aggressive. It's simply to be informed, to be confident. You work incredibly hard for your money. You absolutely have the right to claim every single deduction that you are legally and properly entitled to.